Welcome back to the AG Insider and the wild roller coaster you are seeing in the silver price right now, hitting an all-time high of over $120, violently crashing down to $63 and suddenly bouncing back to $84. This is not a natural market movement. This is not a normal price discovery. This is not supply and demand finding equilibrium. This is a psychological trap designed by Wall Street to separate you from your physical metal before the entire system breaks. The extreme volatility you are witnessing is not random. It is not chaotic market forces. It is engineered. It is calculated. It is a coordinated campaign by the largest bullion banks on the planet to create fear and uncertainty and panic in the retail investor base so that you sell your physical silver back to them at artificially suppressed prices while they desperately scramble to cover their massive paper short positions and acquire physical metal to ship to the east before the vaults run completely dry. And those vaults are running dry fast. The physical inventory in Shanghai has been drained by 77%, and at the current rate of withdrawal, there are only 15 days of deliverable silver left. 15 days. And Wall Street knows this. JP Morgan knows this. The bullion banks know this. And they are terrified because when those vaults hit zero, when there is no more physical silver available in the largest physical delivery market in the world, the paper pricing system is going to collapse and the true price of silver is going to be revealed. And it is not going to be $84. The suits want me to tell you this is not financial advice. And they are absolutely correct. This is not financial advice. This is an exposure of the most sophisticated market manipulation scheme in precious metals history and how Wall Street is using volatility as a weapon to steal your physical wealth before the 15-day countdown expires and the real price discovery begins. Let me know in the comments below right now because this is the most important question you need to answer honestly. Did you get shaken out and panic sell during the crash to $63? Did you see silver drop $40 or $50 in a matter of days and decide the bull market was over and sell your physical metal back to your dealer? Or did you hold the line and keep your physical metal? Did you understand that the crash was artificial, that it was paper manipulation, that the physical fundamentals had not changed? Drop a comment right now. Tell me what you did, because your answer is going to tell me whether you understand the difference between the paper game and the physical reality. And it is going to tell me whether you were going to survive the next phase of this volatility or whether you were going to be one of the casualties who sold at the bottom and then watched in horror as the price recovered and kept climbing. Now let me break down exactly why institutions are causing this chaos and what they are trying to accomplish. Wall Street is terrified right now because the physical vaults in Shanghai are rapidly draining and have only 15 days of inventory left. I've been tracking this in real time. I've been monitoring the vault data. I've been calculating the withdrawal rates. And the math is absolutely clear. At the current pace of physical delivery, the Shanghai Gold Exchange is going to run out of deliverable silver in exactly 15 days. When that happens, when the largest physical delivery market in the world cannot fulfill delivery requests, the entire precious metals pricing system is going to experience a credibility crisis. Because if Shanghai cannot deliver silver, people are going to start asking, can the COMEX deliver silver? Can London deliver silver? Can any of these exchanges actually back up their paper contracts with physical metal? And the answer is no. The answer is that the paper markets have been running a fractional reserve scheme for decades where there are 5 or 6 or 10 paper claims for every physical ounce. And as long as nobody demands delivery, as long as everyone is content to trade the paper contracts and settle in cash, the scheme works. But the moment people start demanding physical delivery, the moment the Eastern vaults run dry and Chinese buyers and institutional investors start standing for delivery on COMEX contracts, the scheme collapses because there is not enough physical metal to satisfy all the paper claims. So what does Wall Street do? How do they try to delay the inevitable collapse? They create volatility. They engineer massive price swings to shake out weak hands and convince retail investors to sell their physical metal back into the system. Let me explain how this works. Silver rallies to $120. Retail investors who bought at 70 or 80 or 90 are sitting on massive unrealized gains. They are up 50% or more. They are feeling good. They are thinking about taking profits. And then Wall Street steps in and dumps massive amounts of paper contracts into the futures market. They flood the market with sell orders. They trigger stop losses. They create cascading selling pressure. And the price crashes from 120 down to 63 in a matter of days. Now retail investors are terrified. They just watch their gains evaporate. They are down from the highs. They are seeing red on their screens. They are reading headlines about silver crashing. They are hearing analysts say the bull market is over. And they panic. They sell. They call their dealer and they dump their physical silver at $63 or $65 or $70. And guess who's on the other side of that trade buying every single ounce? The same Wall Street banks that engineered the crash in the first place. This is the volatility trap. This is how institutional money steals wealth from retail investors. They create the volatility. They profit on both sides. They short at the top. They cover at the bottom. They accumulate the physical metal that scared retail investors are dumping, and then they let the price recover. Silver bounces back to 84. And the retail investors who sold at 63 are left watching from the sidelines, while the people who held their physical metal are back in profit, and the institutions that manipulated the market have successfully acquired more physical supply to satisfy their delivery obligations in the East. The massive paper price crashes that you are seeing, the violent moves from 120 to 63, these are not natural. These are not the result of fundamental supply and demand changes. Nothing fundamentally changed between when silver was at 120 and when it crashed to 63. The Shanghai vaults were still draining. The geopolitical crisis in the Middle East was still escalating. Oil prices were still high. The energy shock was still real. The industrial demand for silver was still strong. None of the fundamental drivers changed. So why did the price crash? Because Wall Street flooded the futures market with paper sell orders to create the illusion of supply and trigger panic selling. And here's the thing that most people do not understand. When JP mainstream financial channels are cheering for this volatility, they love it. They call it exciting. They call it a trader's market. They interview technical analysts who draw lines on charts and talk about support and resistance levels. But they completely ignore the 15-day physical countdown. They do not talk about the Shanghai vault drain. They do not talk about the supply shortage. They do not talk about the Eastern demand. They do not talk about the fact that the physical market and the paper market are completely disconnected. If this channel's mission to expose the paper market manipulation helps you see through the volatility trap, if it helps you understand that the crashes are artificial and the physical shortage is real, then consider hitting that super thanks button below to support this work. This is how I fund the daily vault tracking and the research that connects the dots Wall Street does not want connected. Now let me give you the action plan because the next 15 days are critical and you need to know exactly what to do. You must completely ignore the spot price on your screens. I do not care if silver is at 84 or 90 or 100 or crashes to 70 again. The spot price is a paper illusion. It is determined by futures trading on exchanges that are running fractional reserve schemes. It is manipulated by algorithms and spoofing and naked shorting. It does not reflect the true supply and demand for physical metal. The only price that matters is the physical price. The price you actually have to pay to get coins or bars delivered to your door. And that price is 84 plus premiums. And those premiums are rising. Right now, dealers are charging $6 to $10 over spot depending on the product. But as the physical shortage intensifies, as the Shanghai vaults get closer to zero, as the Eastern buyers start demanding delivery from Western sources, those premiums are going to spike. You might see spot silver at $90, but dealers charging $120 for physical delivery because they cannot source inventory at reasonable prices. And at that point, the spot price becomes meaningless. It is just a number on a screen that does not reflect the reality of what it costs to acquire physical metal. Selling physical silver back to the banking system right now is exactly what the elite want. They want you to panic during the volatility. They want you to sell at the bottom. They want you to give them your physical metal at artificially suppressed prices so they can cover their shorts and satisfy their delivery obligations. Do not do it. Do not fall for the trap. When you see the price crash from 120 to 63, that is not a signal to sell. That is a signal that Wall Street is desperate. That is a signal that they are running out of physical metal and they need to shake you out of your position. The people who sold at 63 are the people who got robbed. The people who held their physical metal are the people who are going to come out ahead when the true price discovery happens. Because here is what is going to happen in the next few weeks. The Shanghai vaults are going to hit zero. The physical shortage is going to become undeniable. The Eastern buyers are going to start demanding delivery from the COMEX. The COMEX vaults are going to start draining faster. And at some point, probably very soon, one of these exchanges is going to default on a delivery request. They are going to admit they do not have the metal. They're going to settle in cash or change the rules or declare force majeure. And when that happens, when the paper market's credibility is destroyed, the price is going to gap up violently. We are not talking about a gradual rise. We are talking about a gap, just like we saw with the $96 gap when Trump deployed the Navy. Except the next gap might be from 90 to 150 or from 100 to 200. Because the market is going to reprice the entire supply shortage in a matter of hours or days once the default happens. You need to secure whatever physical ounces are left in the retail market before the 15-day clock hits zero and the true price discovery violently takes over. Every day that passes, more physical metal gets withdrawn from the Shanghai vaults. Every day that passes, the COMEX registered inventory gets lower. Every day that passes, dealers are having a harder time sourcing inventory. Every day you wait is a day where the available supply is shrinking, and the risk of not being able to acquire physical metal is growing. I am going to be exposing Wall Street's spoofing algorithms and tracking the physical shortage every single week. I am watching the vault data across multiple exchanges. I am monitoring the delivery demands. I am tracking the premium changes at dealers. I am calculating the days of inventory remaining. And I am going to be breaking all of this down for this community so you understand exactly how close we are to the breaking point. Make sure you are subscribed to this channel with the bell notification turned on so you never fall for another fake paper crash. When Wall Street dumps the futures market and creates a $40 down day, I am going to be putting out videos immediately explaining what is happening and why you should not panic. You need that information in real time, not a week later. Here is the bottom line. The wild volatility in silver is not natural. It is engineered. It is a weapon. It is a psychological trap designed to separate you from your physical wealth before the system breaks. Wall Street knows the Shanghai vaults are almost empty. They know they have 15 days or less before the physical shortage becomes public knowledge. And they are using every trick in the book to acquire physical metal before that deadline. They are creating volatility to scare retail into selling. They are suppressing the paper price to hide the true supply situation. They are flooding the futures market with naked shorts to create the illusion of supply. But the physical reality does not change no matter how much they manipulate the paper price. The Shanghai vaults are draining. The COMEX vaults are at multi-year lows. The industrial demand is strong. The investment demand is strong. The Eastern strategic buying is relentless. And there's not enough physical supply to satisfy all of that demand at the current paper price. Something has to give. Either the price has to go vertical to destroy demand and attract new supply, or the exchanges have to default on delivery. There's no third option. I just posted the psychological strategy to survive this extreme volatility without selling a single ounce to my private insider community. I broke down how to mentally prepare for $40 or $50 swings. I explained why you should never look at unrealized gains or losses on physical metal. I showed you how to calculate your true cost basis and why selling at these levels makes no sense. I gave you the framework for making rational decisions instead of emotional decisions during violent price moves. If you want to see how Captain Silver stays calm during the chaos, click the join button below and become an insider member right now. The people who join today are going to have the mental tools to hold their physical metal through the manipulation and come out ahead when the true price is revealed. If you want to understand how the $90 oil explosion in the Middle East is secretly paralyzing the supply chains and making this silver shortage even worse, you must click the video on your screen right now. I break down the entire geopolitical energy trap. Do not wait. Click right here and I will see you in that video.